Did you know that on an $800,000 home loan, you could end up paying almost $775,000 in interest alone? In today's video, I'm breaking down a real Australian mortgage example using a 2026 home loan amortization calculator. We'll look at monthly repayments, total interest paid, how much goes to principal versus interest, and what your first year really looks like. Let's dive in. Loan Scenario Overview. Here are the loan details used in the calculator. Loan amount, $800,000. Interest rate, 5.25% per year. Loan term, 30 years. Repayment frequency, monthly. Interest calculation, daily, Australian Standard Method. First payment date, January 1, 2026. Now let's look at what that actually means in dollar terms. Monthly repayment. Your required monthly repayment would be $4,417.63 per month. That's the scheduled repayment amount, assuming no extra payments. Over 30 years, that consistent payment adds up significantly. Total cost of the loan. Here's where things get interesting. Over the full 30-year term, total amount paid $1,594,764. Total interest paid $774,721. That means you're paying almost the same amount in interest as you borrowed. You borrow $800,000, you repay nearly $1.6 million. That's the long-term cost of compound interest working against you. What happens in year one? Let's zoom in to the first year, 2026. In year one, interest paid $37,987. Principal paid $15,024. Even though you're paying over $4,400 per month, most of it goes toward interest at the beginning. That's how amortization works. Early years mostly interest, later years mostly principal. This is why many homeowners feel like their balance barely moves in the beginning. How daily interest affects you. This loan uses daily interest calculation, which is standard in Australia. That means interest is calculated daily on your outstanding balance. The more days in a month, the more interest you pay. Paying earlier or making extra payments can reduce interest significantly. Small timing differences can have long-term financial impact. Loan payoff date. If you make only the minimum repayments, your loan would be fully paid off around November 15, 2055. That's 30 years of consistent payments. Why this matters? This example shows three important things. Interest makes up a huge portion of total repayments. The early years are heavily interest-loaded. Extra payments, even small ones, could dramatically reduce your total interest bill. For example, even adding a few $100s per month could save tens of thousands over time. If you found this breakdown helpful, like the video, subscribe for more Australian property and finance insights, and let me know in the comments if you'd like to see a comparison with extra payments or different interest rates. Understanding your mortgage is one of the most powerful financial moves you can make. See you in the next video.